Yes, that.
Hi, everyone. This is Brian Dolan from the law firm Pepper Hamilton. Welcome to our latest U.S.-India webinar. We have participants from both the U.S. and India, so thank you for joining us on in both countries. Before we start today, I wanted to go over a couple of housekeeping items in case you haven't joined us for a webinar. One, we are recording the session today. Two, I'm going to put up a screenshot here. If you are hearing your audio through the computer and you don't want to hear it through the computer anymore for some reason, you can click a icon I'm going to highlight here to ask for a phone number, and we have international phone numbers as well. So if you wanted to have a 1-800 number or a toll-free number, you can ask for that. Also, we would love to have questions. So if you hit the Q&A tab, that will allow you to send us questions here in New York, and we will go through them as we get them through the hour today. And also, please download the PowerPoint slides as a takeaway. But you can do that by clicking File, doing a Save As, which I have a screenshot here, and select PDF. And that's how you can get that as a takeaway. With that, I'd like to turn it over to Valerie DeMont, who's the head of Pepper's U.S.-India practice, who's going to be our moderator today. Valerie?
Thank you, Brian. Good morning for those of you in the U.S. and good evening for those of you listening to us from India. We certainly appreciate you staying up so late to hear what we want to talk about today, which is really focused on recent trends and developments affecting the IT services and e-commerce sector between the U.S. and India. I'm Valerie DeMont. As Brian indicated, I'm a corporate and securities partner, chair of our U.S.-India practice. Pepper has a very vibrant U.S.-India practice focused on advising companies that go and do business and invest in India, as well as Indian companies that come and do business and invest in the United States. And in fact, my partner Jim Rosner, who chairs our international practice, and I were in India very recently, and we make these trips every year in order to really get a good sense of what's going on in India. And I must say, this year was quite exceptional in terms of developments, vibrancy, activity, change, and the uplifting mood. We were in India right before the start of the Make in India campaign and right in the wake of the Startup India campaign. And with that, I'm really delighted to have with me two partners from Khaitan & Co., Daksha Baxi and Thomas Phillip, and my partner, who's the chair of our tax practice, Joan Arnold. I'll say a few words about them, and then we'll go right into the subject. And as Brian indicated, you should feel free to ask questions throughout the session, and we will try our best to respond to them either as we go or at the end of the session during the Q&A. So first, I'll turn to Joan, my partner, Joan Arnold, chair of our international tax practice, who focuses our practice on federal and international income tax, has been very involved in structured investments in and out of India into the United States and out of the United States, has more than 35 years of experience in domestic cross-border M&A and corporate international tax counseling, including substantial tax experience in the private equity arena, is the president of the American College of Tax Counsel, vice chair of the tax section of the ABA, vice president and member of the executive committee of the U.S. branch of the International Fiscal Association, and on the executive committee of the George Washington IRS Annual International Tax Institute. She lives and breathes international tax, and she has found her match in Daksha Baxi, who is an executive director at Khaitan & Company. Khaitan is a large law firm in India with whom we've worked on a number of cross-border matters across both M&A, private equity, and other international transactions. Daksha focuses her areas for Khaitan & Co. include direct tax advisory, structuring of inbound and outbound investments and exit strategies, India entry strategies for nonprofit organizations, as well as educational institutions and philanthropic organizations, and asset protection and tax-efficient wealth management. And she must be quite busy these days with all the recent activities in India, particularly on the cracking down on tax evasion. She's also a chartered accountant at the Institute of Chartered Accountants of India, is a graduate from the Manchester Metropolitan University, a fellow member of the Institute of Chartered Accountants in England and Wales, and a fellow member of the Institute of Chartered Accountants of India. With Daksha, it's her partner, Thomas Phillip, who joins us from India. Thomas is a partner focused on merger and acquisitions, both domestic and cross-border, very involved advising private equity funds, included with respect to their listed companies, as well as venture capital, domestic and cross-border joint ventures, takeovers, foreign investment law, and corporate and commercial law advisory. He's a graduate of the National University of Juridical Sciences in Kolkata and a member of the Bar Council of Maharashtra and Goa. So thank you very much for coming and talking to us today about what's going on in India, particularly as it affects IT services and e-commerce. This is obviously a very vibrant sector in the U.S.-India trade, both with active investments by Indian IT services companies in the U.S., as well as obviously extensive business providing services to U.S. and European companies out of India. This sector has really undergone tremendous growth and is attracting a lot of interest from an investment standpoint for both venture capital and private equity. And we want to talk a little bit today about some of the regulatory developments, particularly as it relates to Startup India, latest trends in the IT and commerce sectors, including consolidation, valuation issues. There's a little bit of a bubble going on there. What it means for VC funds and PE funds that invest in that sector, and more importantly, what are the tax developments that are really affecting the sector, both startups as well as growth IT services companies, and what's going on in the area of permanent establishment, and what's the new rules of the game in that space. So I would like first to turn this to Thomas from Khaitan & Co. And Thomas, if you could tell us a little bit, what is Startup India? What's going on there?
Right. Thanks, Valerie. Thanks very much for the introduction, and a very good afternoon to everyone. So just to, again, run through the structure of the webinar, I think I will start with two recent policy initiatives taken by the government, which has a significant impact on IT, ITES, and e-commerce sectors in India. The first one is, as outlined by Valerie, is a startup policy formulated by the Department of Industrial Policy and Promotion. And the idea of this entire startup policy is to provide a very strong ecosystem that will nurture innovation in the e-commerce and ITES sectors, which will in turn lead to economic development and greater employment opportunities in India. The second bit of the policy initiative that came about recently is the amendment to the existing FDI policy vis-a-vis the e-commerce sector, and this has, sort of considerable impact in terms of how the existing structures, which has been used by e-commerce sector players, how that will be analyzed and what kind of changes they will need to implement going forward. Just to start up with the startup initiative, this has been sort of a personal initiative that's been spearheaded by the Prime Minister of India. And, as I said, it aims at fostering entrepreneurship and promoting innovation by creating an ecosystem that is conducive for growth of startups. And the stated objective of the startup policy is that India must become a nation of job creators rather than becoming a nation of job seekers. So that's the large level policy objective of the Startup India initiative. And just to give a bit of a political background to this policy, I think this came about due to a combination of a number of factors. I think the previous government, has been perceived for a long time to be suffering from policy paralysis. And I think overall the feedback, be it from the foreign investment community or even domestic players, has been that there were no reforms, which took place at least in the last part of, the previous government's rule. And certain measures, unfortunately, taken by the previous government, I think those were decidedly investor unfriendly because a lot of them had to do with, retroactive taxation. So, when the new government came in, I think the expectation was that, there would be decisive big bang reforms once, the government comes in, because the new government has come in with a significant majority in the lower house of the parliament. So while this was the expectation, I think at a ground level, what the government experienced was that it is increasingly difficult to push forward reforms because while the government does have the majority, the BJP has the majority in the lower house of the parliament. Unfortunately, at the upper house, it is still in a minority, and hence at least the more difficult reforms, that would come by, which will need a bit of consensus in areas such as labor and a unified tax regime. I think that has been increasingly difficult to come by. But at the same time, what the government felt was, they need to move forward with reforms, and they need to have a couple of at least decisive measures, that will sort of appease the investment community and overall, the commercial economy in India and the sectors in India. So what at the same time happened is, the real economy and infrastructure growth, while the government did try to push forward a few reforms, I think the growth has been lukewarm at best. At the same time, what has happened is in the last 3 years, what has been happening is both investments and growth in the technology sector, it did rather take off in a contrarian fashion, despite global headwinds, what has been happening in India as well as abroad. And this development and this growth in the sector has been despite receiving no attention from the government. So I think from a political perspective, this was sort of an easy sector to put one's weight behind, and hence I think, what the government also felt was the political dividend was certain and immediate, and it was already a sector that was doing well. So now from that perspective, I think the primary aim of the startup policy to accelerate spreading the successful startup wave. And when I say a successful startup wave, I think we can trace this back to about 3 or 4 years, where I think in sync with the US appetite, venture capital community appetite for technological investments, what has happened in India was there was a corresponding boom here, whereby I think there was a spillover from the Silicon Valley appetite for tech companies. It also transpired into a wave of investments in e-commerce sector in India and startups as a whole. So I think given that the government did recognize that, this was a model, for whatever reason, there has been, contrary to other sectors, there has been growth and there's been investment in the sector. And I think the primary aim of the startup policy was that, this entire successful wave should be replicated in a wide array of sectors like agriculture, manufacturing, social sector, healthcare, and education. So that was one objective. And the second thrust was, from a geographic perspective, what the government realized was this is an opportunity maybe to shift the entire growth, which has been sort of concentrated in the tier 1 cities. The idea is to take the same model and replicate that in tier 2 cities and even in semi-urban and rural areas. So based on these two thrusts, I think the startup policy, the idea is that to provide the startups an environment, that is conducive for growth, and conducive for not just growth, but in a scale, that it has so far witnessed, and maybe, even more exponentially so going forward. So coming back to that, I think if you look at what the thrust, as in how the startup policy aims to implement this, is twofold. I think one is to simplify the compliance regime that exists in India, and the compliance, if you were to ask me, I think it's fairly challenging, even when you are looking at full-scale, well-established companies having to follow the compliance in India. I think that's a fairly onerous process. So the government's idea has been that let's simplify this for the startups in India, because the primary purpose of that being startups, given by their very nature, I think they will need to concentrate more on the business, the core business of actually developing it, rather than maybe focusing on compliance and other things which are ancillary to their business. The second thrust of the policy is to introduce certain tax benefits for startups, and this part of it, my colleague, Daksha, will deal with it, when it comes to her slides. So just coming back to what a startup is, I think the definition has been, it has been streamlined now to read as, it can be a private limited company, it can be a registered partnership or an LLP, and this entire phase of what a startup will be, it is time-bound. You can enjoy the benefits, and you will continue to be a startup from the date of incorporation until 5 years from the date of incorporation. During this period, that in no single year should your the target's revenue exceed 250 million Indian rupees. So again, the idea being that, once it exceeds that certain scale, then the government's thought being that, you no longer require the beneficial regime they have introduced for startups. So the idea is to limit it to very small companies and for a certain period. And the last one is, if you look at the slide, I think the criteria has been that, the company should be working towards innovation, development, deployment, or commercialization of new products, processes, or services driven by technology or intellectual property. So while, yes, as in this sounds very good on paper, I think The challenge will be that, going forward, how, despite the fact that you fulfill this criteria, you will still need to get a certificate of registration from an interministerial board of certification. So it's a government body that will certify whether, as a startup, whether while you meet these conditions, whether you are eligible for the benefits. So there is a certification process there. And given the fact that it's a government body that's going to actually look at applications and decide whether a certain entity will be a startup or not, there I think the general apprehension here is how will they interpret the last criteria, which says that the company should be working towards innovation, development and deployment or commercialization of new products, processes or services driven by technology. Because I think the natural question here is, for example, I think when Uber would have come out with the services, definitely, that was an innovative model. But the question is today, if one more player were to enter this entire market and as a taxi aggregator, then the question is, for the purpose of certification and getting the government benefit, it's not clear whether what the government's view is, whether it will be considered as a new product or a new service, or will the view be that, given the fact that there is already an existing provider in the market, whether this will not actually meet the condition, the last condition, which says that you should be engaged in either introduction of a new product or service. So that is one I think issue which I think over time, as in maybe in the next 3-4 months, once the budget, once the finance bill actually comes out, when that is a time when we may have a bit more clarity on this. But while there is a little bit of ambiguity in terms of what would constitute a startup, and the apprehension also stems from the fact that you will need to apply to a government body to get the certification. I think largely, again, while these issues are still there, one would certainly welcome the moves as something that is positive.
So Thomas, if I can ask, has this regime already been implemented? Is it effective today, and are companies registering as startups?
It is, yes. It is, in fact, effective as of now, but insofar as I have not seen examples of any registrations, I have not heard of any registrations being granted yet. So there is an e-platform on which I think you can make applications already. But as I said, I have not heard of any company being registered yet under this regime.
Okay, and then you talked about some of the compliance simplifications. What does that mean, therefore, to be registered as a startup?
So yes, once you get this registration, I think the significant ease of compliance, I think, has been in relation to labor law compliances. So I think what happens under various legislations in India is there is a whole lot of filings that will need to be made, I think, in most cases on a monthly basis or even at a quarterly basis. And I think the trigger for most of them is, I think, around 20 employees. And once you cross that, with that limit of 20 employees, you will need to make these filings. And these are pretty onerous in terms of, the kind of the managerial bandwidth, that will be taken to make these compliances. And if you look at it, these labor law legislations are enforced by the state government machinery, where it still functions, not exactly in the most streamlined and company-friendly manner. So I think what the government has done is, for the first 3 years from the date of establishment, irrespective whether you have crossed that limit of 20 employees or 10 employees, you are actually given the freedom to actually self-certify that you're in compliance with these regulations, rather than making these onerous and detailed filings. So that is the significant, I think, compliance regime that has been eased specifically for startups. And specifically, I think what the government also said is that there will be no inspection in the first year of operation. So I do believe that this benefit should have been extended to perhaps even 3 years. But inspection in the Indian labor law regime it's a pretty onerous process. It's effectively, you will have an inspector that will come and that will throw up everything open and will effectively say that you have not complied with X, Y, or Z. So you do have, as in, it's not a very friendly process, and I think the government does recognize that, at the ground level, this is what is happening, and the process is not very friendly. So what they have said is that for a period of 1 year, there is not going to be any kind of government inspection. So I think this is one aspect, that has clearly come out. Separately, this entire startup policy is still being finalized by the government in the sense that various government departments are still considering what they can do from their end to actually push forward this policy. So, for example, the RBI has released a draft paper sort of thing where they have said that startups will get a easier compliance and reporting regime for overseas investments, for receipt of foreign investments. So they have indicated that this is the direction in which they will move in terms of adding a little bit of fillip to the Startup India initiative. But these are currently just at the stage of proposals, and nothing solid has come out yet. But largely, I think the idea is that what the government wants and what the various governmental bodies will do is that from a compliance and reporting perspective, the startups will certainly have a much more easier regime than a regular company.
And I see from your slides that you do have additional relaxation on intellectual property and public procurement policies. I'd like to talk a little bit about, FDI, and if we could move to FDI and talk about what it means for foreign investors, what's happening in the e-commerce sector as a result of all of these changes.
Right. As in, this is, I think, from a Startup India perspective, it does not exactly distinguish between foreign investors and Indian investors. I think the benefit will be available to every private company registered in India. So if let's, for example, if we were to take a US company to actually have a subsidiary in India, I think the relaxation will be available equally for everyone. So at least from a Startup India perspective, the idea has been to not maybe distinguish the companies based on ownership, be it foreign or be it Indian. But if you were to fulfill those criteria, basically if you were a small company with your revenue not exceeding a certain threshold, and if you should be engaged in a sector that based on the criteria, if it actually is innovative and if it introduces a new product, the benefit should be available for all. So that's what the Startup India initiative effectively says. And as an added bit of it, I think the government has also said that, they will create an empaneled body, that will provide intellectual property related assistance to startups, because sometimes what happens is you do have a wonderful idea, but maybe the startups, they are not aware of how you can actually protect this idea from an intellectual property perspective. So I think the idea has been to create further panels within this entire framework who can give up pro bono advice to startups for protection of intellectual property. One more added boost the government wants to give is that starting from April 2015, all government procurement, I think it has been mandated that 20% of that should actually come from MSEs. MSEs are medium and small enterprises, which effectively, as in if you look at it, somewhere would overlap with what a startup is. So what the government has done is that, typically for a government tender, it will typically ask for experience of something like, 5 years or 10 years, depending upon what the procurement is for. The experience criteria is typically slightly on the more onerous side. So what the government has now said is if a startup should actually apply for, should be part of a tender process, then the track record and turnover criteria, which is invariably there, will be relaxed specifically for startups. So the idea, again, is to give a further boost to this entire sector. And the last bit of it is where the government has also said that, aside to actually, apart from actually fostering investments, the government will also set up a fund pursuant to which the government will deploy money into certain startups. So based on, again, there will be a panel that is formed and they will recommend, which all entities the government should invest. So while this is good, I'm not particularly, I personally am not a huge fan of maybe government being a stock picker and, maybe figuring out, which are the good startups to invest and not. But then again, from a larger intention perspective, this is welcome because the government is all of a sudden saying that not only do we recognize the contribution that the startups have made, but maybe the idea is to give, in addition to a tax break, the idea is to maybe put money into these sectors. So yes.
If you could spend a few minutes then talking to us about what's going on the FDI front, and then I think we'd like to move it to the PE investments and tax.
Right. So this brings me to my next slide, which this basically is a press note that was introduced by the government very recently. And overall, the idea has been either to liberalize certain aspects of e-commerce, foreign direct investment e-commerce, or to clarify certain aspects in the e-commerce sector. So now, before I think I go into it, I think it is important to have a bit of background about FDI in brick and mortar retail in India, because while this press note actually broadly addresses e-commerce as a whole, I think if you look at the specifics, I think it is largely addressed at e-retail in India, and hence I think we need to understand the background from which this liberalization or clarification has arisen. So if I were to take all of us back to maybe 10 or 15 years back in terms of where FDI in India has been, historically FDI in retail trading has always been prohibited. The primary policy concern behind such a prohibition has been to protect the local small grocery shops that form bulk of unorganized retail trading industry in India. And from a numbers perspective, I think these small grocers, they are just sheerly big in numbers, so much that they always represent a very sizable vote bank in terms of politics. And hence, I think despite each and every party coming into power, I think the position has always been that retail trading is not going to be open to foreign direct investment, because that will prejudice the small grocers in India. So this is where historically the perspective when it comes to foreign direct investment in retailing has been concerned. I think there's been a move towards progression, because I think in 2005 what happened is the government liberalized what is now known as the single brand retail policy. So this is where basically if a foreign brand were to open its stores in India, they could retail a product under one brand name, and significantly I think not only has FDI been permitted in single brand retailing, subsequently I think it has moved, the earlier stringent conditions have been relaxed, and now it is progressing towards a much more liberal regime. From a multi-brand retail perspective front, what happened was, I think in 2012, up to 51% FDI was permitted in multi-brand retailing. However, the set of conditions that was imposed, I think they were quite stringent, including that I think the initial investment, upfront investment was about USD 100 million, of which 50 million was supposed to be deployed in back-end infrastructure, excluding land. So I think from a practical perspective, what has it has turned into is that while the policy has been liberalized, I think we have just one example of a foreign player actually going down this route and making an investment in India. So plus on top of it, I think the sensitivity with retail, multi-brand retail has been that this is a subject that is regulated both by states as well as the federal government, given the structure, the federal structure that we have in India. So accordingly, each state has the freedom to say that either retail FDI and retail trading is permitted or not permitted in India. And accordingly, so far we just have about 11 or 12 states and federal territories where this is indeed permitted. While liberalization has happened and FDI has been permitted, in practice this has been extended to only about 12 states. Now, while this prohibition has been present, I think as a parallel development, what happened is in 2007, Bharti Enterprises and Walmart of the US, they formed a joint venture, ostensibly in wholesale trading, wholesale cash and carry trading. But I think the variation which they introduced to this entire joint venture was that while the foreign investment will come in a company which does only wholesale trading, which is only, it will only sell to another, it's just a B2B trade at the end of the day. It will not make its sales to the end user, the end consumer. So the variation to this entire wholesale cash and carry trading which they introduced was that the joint venture would in turn sell its goods to a Bharti Enterprise owned company which will operate retail stores. On top of it, I think what also happened was Walmart provided a fair bit of know-how and provided various other bouquet of services that would have enabled Bharti Enterprises to operate its retail stores. So at that point in time, investment even in wholesale trading and cash and carry trading sector was under the government route. So Bharti and Walmart did in fact go to the government, disclosed all these arrangements, and in effect said that this is what we are doing. And the government did approve this entire structure. So many people now going back, they say that this was actually it was sort of a backdoor entry for multi-brand retailing in India. While people do say this was actually done pretty much with the government's knowledge, and the government, if you were to say, looked at the entire application and sort of blessed the structure. So this sort of, was a deviation from until then the erstwhile, the stringent policy on no multi-brand retailing, because commercially, if one can always argue that, this is in effect undertaking multi-brand retail trading in India, and it is only a legal structure that is pursuant to which people are claiming that it is not. So now what happened is, once the structure was established, I think there were a couple of other brick and mortar retail chains, that entered in India. For example, Woolworths of Australia, they set up a joint venture with Tata's in India. So this, in fact, gave about, gave birth to a structure pursuant to which you could sort of do, if I were to say, sort of engage in retail trading in India, but at the same time in a legally permissible manner. So now from 2007, I think in about 2008, 2009, we had FDI coming into the first of the e-commerce companies in India, which will be the present Flipkarts and Co. So while in 2009, when foreign investment started coming into it, what the e-commerce industry did was pretty much replicate the same structure, which the erstwhile, the brick and mortar Bharti and Walmart and the Trends and the Woolworths did. So they pretty much replicated the structure pursuant to which the foreign investment came into an entity that is either engaged only in wholesale trading, cash and carry trading, or it is engaged in providing a bouquet of services like warehousing, logistics, inventory management to a company which is Indian owned, which in turn is the retail company that made the endpoint sale to the Indian customer. So this has been a structure that has been subsequently exploited by many e-commerce companies, and I think for a period you had all these companies which operated in this fashion, and this sort of gave the terminology that was used that this was an inventory based model, because at the end of the day the company that received foreign investment had significant control and ownership over the inventory that is ultimately being sold to the end consumers. So this was known as the inventory based model. Over a period of time, what happened is people genuinely from being a pure inventory-based model company, I think they also moved into becoming marketplaces, pursuant to which what happened is the website or the m-commerce platform listed goods of various other third-party sellers. So in a marketplace, you have third-party sellers listing their goods on websites or portals owned by e-commerce companies. So this is what the structure that has been exploited by the e-commerce companies in India, and this has been going on for, as I said, the initial investments in the sector would have come in about 2008 and 2009, and so far, we have had this much of a period where these structures were being used by everyone. The government was very well aware of it, so during this whole while. Now, I think what happened, I think, is in the last 2 or 3 years, there has been an increasing demand by the brick and mortar retail chains in India to liberalize multi-brand retailing in India. And their entire grouse has been, and this entire concern has been voiced on the fact that what in their view, e-commerce and e-retail in India has been liberalized for FDI. FDI is being permitted in e-retail in India through these structures. But at the same time, brick and mortar chains, I think they were being prejudiced because you could not have done the same thing in brick and mortar is what the argument was. And I think this this came to a head so much, I think last year, so much that the brick and mortar chains, I think they filed a case before the Delhi High Court against the government and against many of these e-commerce companies, saying that this, what the structures that is being used is violative of the FDI policy restriction on e-retailing in India. And that is how the case progressed. And while this was pending, the government, in a filing made before the court, I think it effectively said that, look, the FDI policy does not distinguish or does not recognize an e-retail company at all. So, and that was pretty much about it. It was no further clarity was provided in terms of whether not being recognized, does it mean, is it prohibited, or not being recognized, does it mean that is it permitted? So I think it is in the light of these developments and this historical background that this press note 3 of 2016, that has been introduced. And if I were to say by this press note, what has effectively happened is the government has clarified and it has sort of blessed the structures, that has been in place in the market for now for almost, 5-6 years. It has actually given legitimacy to many of the structures which people were challenging at various points in time, saying that it's a backdoor entry for e-retail in India. At the same time, it has sort of imposed certain conditions, pursuant to which I think the intention of the government is clear. insofar as anyone is operating as a marketplace model. A marketplace model is where a third party is listing its goods on a web portal, and the web portal operator does not have control or ownership over the inventory that is being sold on its portal. So that is a marketplace model, and the government looks like it would permit and it will encourage FDI in the marketplace model of e-commerce. But at the same time, it will not permit FDI in an inventory-based model. And this is just the latter bit of it. I think it is just clarificatory, because you could never have done retail trading in India in any manner, be it through brick and mortar or e-commerce. So the latter bit of it is, I think it's just confirmatory. But the welcome part of it is that the marketplace structure, which has been used by many of the leading e-commerce companies, that has been now sort of blessed by the government. Of course, I will just go through the conditions, which are important. And one major clarification is that the marketplace entities, which has foreign investment, can also provide support services like warehousing, logistics, order fulfillment, all those bouquet of services which is presently being provided by these e-commerce operators. I think the single biggest condition, I think, that will affect many of these e-commerce companies is the restriction that says that not more than 25% of the sales made over the e-commerce portal can be from one entity or its related parties. So now here, again, the intention of the government has been that, insofar as companies that are pure play marketplaces, the government will encourage FDI, and the 25% restriction is to ensure that the previous structures which people have used, whereby you separate the front-end retail entity and the back-end wholesale entity, that kind of a structure is no longer workable because of the single condition that not more than 25% of the sales can come from a single vendor. But at the same time, I think the restriction is there, but I think people are already exploring structuring options, because similarly, I think about a few years back, the same kind of restriction was imposed in wholesale cash and carry trading, whereby when the government finally took cognizance of the fact that people are using these structures to sort of bypass the policy on retail trading, they did impose a condition that 25% of the sales made by a wholesale trading entity cannot be to a related party. So while of course the government did impose this condition, I think the players in the market, restructured their operations and, ensured that the ultimate retail trading entity is not in any way related to the entity receiving FDI. So while the new condition has been imposed, our take is that, this is something which people can structure the way out of, and people are already actually doing that.
And talking of structure, I think it's right to now move on to tax and talk about how all these changes have really been also driven in part by tax considerations on the structuring, structuring of the investments in and out of India, what startup has done with respect to tax incentives, and more importantly, what's going on with respect to permanent establishment issues. And for that, I'd like to turn it to Daksha and Joan.
Thank you, Thomas and Valerie. This is Daksha, and hello, Joan. So please interrupt me as you want to have clarity. So I'll just start with a few incentives that have been specifically given to startups in line with the startups policy of the government of India, and these incentives are proposed in the Finance Bill 2016, which was presented by the Finance Minister in the Parliament. It is under debate right now. Once it is passed by both houses of the Parliament, it will become law, and most of the provisions of the Finance Bill will be then incorporated in the Income Tax Act 1961, and therefore will become statutory provisions. So the first one is that for a startup, for the first 3 years out of the first block of 5 years, a startup can select or elect to be exempt from 100% of its income. the way it works is that in the first year or two, perhaps, if the startup does not have any profit, then it does not have to automatically be exempt from tax in the first year or the second year. It can elect to be exempt from tax from third to the fifth year. So 3, 4, and 5, those 3 years, when it actually is starting to make profit, it is able to claim the deduction and claim tax exemption. So this is something which is a very, very positive move and very helpful to the startups who do have a lot of cash constraints, essentially in the beginning, and therefore not really profitability. And for this purpose, startup has to be, as Thomas already said, be certified by Interministerial Board of Certification. Then there are further measures which have been put in place to mobilize significant investment in startups. Thomas mentioned about a fund that the government is creating. Now that is, in the first place, if someone who has invested in startup and is exiting and is making capital gains from that, those capital gains will be exempt if the capital gains are then invested into this particular fund or in a startup company. So that is something which is a benefit that is given to people to make more investments in startups. So that's one thing, and then. These are the provisions which are intended to give a boost to investment in startup and make profits even out of the investments made in startup. So now I'm going to move, Joan, unless you have something that you want to clarify.
No, my only comment was that the startup can be a subsidiary of a U.S. company.
Yes, it can be. As long as it is a company which is set up in India,
right.
It doesn't matter whether it is owned by Indians or a U.S. company or any other company.
Does that long-term capital gain exemption, if you roll it into another startup, also apply to the tax on the sale of an Indian subsidiary?
Yes, that's right. If that Indian subsidiary itself is a startup,
right.
Then if that the gains are realized on sale of those shares,
right.
and they are reinvested in a startup fund or in a startup company, then yes, that rollover benefit will apply to the U.S. company who
right.
is an investor as well. Yes.
That's interesting.
Yeah. So now I'm moving on to some of the aspects which are, as such, not only limited to startups, but are relevant from the perspective of whoever is making investments and is dealing with India. And most of it is the permanent establishment traps. India does have very, very aggressive regime in terms of, I suppose it's most other countries also have, probably U.S. also has, but there is a pretty aggressive regime in terms of determination of permanent establishment. Of course, whatever is the treaty provision for permanent establishment are respected, but where the treaty is not applicable, so if an investor is a U.S. investor who has invested through a subsidiary, let's say, or a fund in Cayman Islands or British Virgin Islands into India, there is no treaty between India and British Virgin Islands or Cayman Islands, and therefore then the domestic law of India will apply in respect of such an investor who is investing.
What if that Cayman entity is a partnership and all the partners are U.S. people? Will you look through that?
No, because there is no treaty between India and Cayman Islands.
But the U.S.-India treaty says that we should look through partnerships.
That is provided it is a U.S. partnership.
Okay.
You can't apply the U.S.-India treaty provisions to a partnership which is in Cayman. So that wouldn't apply. So in that situation, the Indian provisions will apply, and Indian provisions are pertaining to what is called a business connection in India,
mm-hmm.
not a permanent establishment. And business connection is more widely defined, and it is kind of, any relationship which is on a continuous basis that let's say the Cayman entity has with India, and some activity happening in India as a result of which the Cayman entity is deriving income, then that is called business connection, and that income would be taxed in India. So there is a benefit in investing through a treaty jurisdiction, and India-U.S. treaty is, I'm afraid it's not the best for permanent establishment, because under the India-U.S. treaty there is a concept called service PE. If you see on the first line there, you see service PE, fixed place PE. Service PE is when the U.S. entity is furnishing some services to its subsidiary, let's say.
In India.
In India. And because they are related parties, subsidiary and the U.S. entity are related parties, the treaty says that even 1 day's presence of a person of the U.S. entity in India while furnishing those services creates permanent establishment of the U.S. entity in India. And therefore, whatever is the income which is pertaining to those services will be treated as arising in India and will be taxed. Now, unless that particular income is covered under a fees for included services article, in which case that article will prevail and only 10% on the gross basis will be taxed. But the fees for included services article is pretty good in terms of the fact that if you are not making available technology, know-how, expertise, etc., but you are providing, let's say, managerial services, which is just, how to run your company and things like that, then that doesn't form part of the...
do you distinguish between providing services to the related party in India versus going over as your role of owner and going over to see how things are going?
Right. Yes, there is a distinction on that, though the distinction is quite blurred, and that's coming only out of court rulings rather than rules in the income tax law. So therefore, what happens is there are interpretations on both sides, but there certainly is a distinction created. So what you perform by way of being you send someone to look after your own interests.
Right.
In that company, then you're not furnishing services to that entity.
I will say that practically speaking, yeah. I have the Indian head person come to New York.
Correct, absolutely, rather than the other way around.
Rather than having to deal with it.
Because it won't be service fee, but it can become a fixed place fee. Because the person, from the U.S. person, if he is in India while looking after the interest of the U.S. entity for a long period of time, then he will have an office at his disposal, yeah. which becomes a fixed place PE.
Yeah, that we also.
Yes.
On your slide, you have secondment of employees,
yes.
and you raise a PE question there.
Yes.
And I would like to discuss that, because when I say I'm seconding an employee, what I mean is that I'm taking them off of the payroll of, say, the U.S. company, and I'm putting them on the payroll of the Indian company, and I then assume that does not create a permanent establishment in India for the U.S. company, because I've moved them from payroll to payroll.
Right. So if you actually move them from the U.S. company's payroll altogether, then there should not be an issue at all. But a lot of secondments happen where the employee continues to be on the payroll of the U.S. company for social security purposes. All the contributions which need to be made, they need to be on the payroll of the U.S. company, and they are also on the payroll of the Indian company.
And
so therefore, in those situations, there have been court rulings where, depending on exactly how that person is functioning, it can create either a service permanent establishment or a fixed base permanent establishment.
But if the control over the employment is exercised by the Indian company,
yes,
to whom the person has been seconded, you're okay.
That favors more in terms of not creating a permanent establishment, but that is exactly what, the last line says. The determination of PE is vital. It's a mixed question of facts and law. So each case needs to be examined as to what you need to, or how you do it, because each company will have its own requirement as to what they would like their employee to do in India.
Right.
So that needs to be
considered. Now, if you have a branch, obviously if there's a branch office, say you have a fixed place PE, is it common for companies to branch into India?
Not really, for several reasons. Of course, it becomes a permanent establishment is one tax reason, but also because a branch office of a foreign company in India can only be established after getting approval from the Reserve Bank of India. And that approval for branch office is not very easily forthcoming because Reserve Bank of India is not very, do not look at it in a very, very approving manner. What they say is you have the ability to have your own company. Why do you want to have a branch? It becomes rather difficult for them to manage the funds flow because of the exchange control regulations, and therefore they prefer to have not to have branch offices.
And it's the same for liaison offices, where you do need to get regulatory approval too.
You do need regulatory approval for liaison office, but that is easier to get than a branch office because liaison office is specifically not permitted to earn revenue. It is only liaising and carrying out, preparatory and auxiliary activities. So it doesn't generate any revenue.
So maybe we should move to transfer pricing.
Yes.
Because we've had such a nice surprise. Back in 2013, the IRS broke off negotiations with the Indian tax authorities and refused to continue to try and work. They had more than 200 transfer pricing cases that were being contested between India and the U.S. We broke it off in 2013 and then went back and said, okay, we need to have a principled way to analyze these things. And in 2015 came up with a framework for how to analyze transfer pricing cases. And since then, they've settled more than 200 of them. And starting on February 1st, the U.S. government at least started taking applications for advanced pricing agreements.
Right.
So what's going on in India with this?
Yes, India, we've been hearing good things about transfer pricing situations in India. First of all, the advanced pricing agreements regime started in India just 2 years ago. And we were very apprehensive because of the experience of mutual agreement procedures not being so
not working
so encouraging. But what we have seen is that in the very initial year, the concerned authority received 250 applications.
Wow.
And the applications have obviously increased very significantly. And just as of the end of 31st of March, the authorities had cleared and signed 69 advanced pricing agreements.
Wow, that's wonderful.
Yes. What I know is that the U.S. APA authorities sign over 100 APAs every year. I don't know. You know the numbers better. This is what I was informed, and what I was also informed is that the U.S. APA authorities have a much larger team than the Indian authorities have, and because ours is just starting off. And with this experience, they are very encouraged, and they really want to increase the strength of the
So
team.
do we think now I'm going to be able to tell my clients that they don't have to plan on cost plus 25% as their transfer pricing model?
Well, they can if they want to, but they can also actually approach the advanced pricing authorities and get an agreement.
Do we have any sense as to how they're treating taxpayers? In terms of
very well. In fact, there are some of the taxpayers that we know of who have been very, very pleased with the manner in which they are actually examining, and they even help the taxpayer in terms of what it is that they want and how it is that they will be looking at. There are, out of the 69 that I just mentioned, I think majority are, of course, unilateral, but there are some which are bilateral, and some with the U.S. which are bilateral. And as you might just know, they are valid for 5 years. after signing, and they also have a rollback of 4 years.
It's very nice certainty.
Yes, very nice certainty. So I would certainly recommend to get your clients to enter into advanced pricing agreements, and we'll be happy to have that.
Yeah, it's not that common in the U.S. to go in for an APA.
I understand.
Because they take 2 years to come out and get one.
Right.
And it's usually the very large companies.
Yeah.
So a lot of clients look at that and go, no. Mm-hmm. But they also don't want to apply your safe harbor for transfer pricing.
Now, safe harbors are, or even in India, the safe harbors are really not very promising safe harbors because they're very high rate.
Yes.
So you probably don't really want to go via that route, and the FAR analysis and everything always gets very difficult to contest.
So I wanted to talk a little bit about poems.
Yeah.
Sounds lovely. So, but I don't think the reality behind it is that lovely.
Because this one is not a real poem, it's only an acronym. Place of effective management. That is, India had a very interesting residence rule for companies till 2015. What it said is that a company would be resident in India if it was incorporated in India or its control and management was wholly situated in India. And this meant that a company could actually be residing somewhere else and be literally controlled and managed from India, except for some part of the decision-making may be located outside India, and then it would escape being resident in India. So this is something which the government and the revenue authorities were not happy about. So this was changed to bring it in line with the international practice of saying that a foreign company, will be regarded to be resident in India if its place of effective management is situated in India. So now, and place of effective management critically is at the moment defined to be where the important and relevant commercial decisions for the company as a whole are substantially taken. So not all of them, not some of them, but substantially. Now that's what is open to debate, and for that the government is coming out with rules. Already the guidelines, draft guidelines have been issued where it seems what they would like to do is they would like to divide up the company, such companies, into companies which are only passive income companies and companies which have active income. And passive income will be income from investments, income from royalty, income from license fee, like that, and a trading income where the trading income is coming out of the trading in group companies. So that is the kind of thing which will be considered passive income. All the rest will be active income. So in case of active income, the test is mainly where the board meets in majority of the cases, which is easier to satisfy. In case of companies which are passive income companies, they will look at several things in terms of, where the employees are, majority of the employees are, where if the employees are outside India and in India, whether more than 50% of the employee expense is incurred in India or outside India, and a variety of number of things. The rules have yet to be notified because there are certain clarifications which needed, and a lot of comments have been given to the government, so they are just considering that. Once they are out, it will be clearer. But yes, therefore, each and every foreign company will have to make sure that if they have their, like there are a lot of IT companies, for example, who have their holding company outside in the U.S. or a subsidiary in the U.S., and subsidiary actually does more work in terms of, being a face to the customers, but the actual work of development of the software product, or anything that is being offered to the customers is being done in India. And for the purposes of making sure that everything is properly done in India, the person who is the main person in the U.S. subsidiary really does reside in India. So that is the kind of, situation because if he is residing in India and he's participating in the decision-making process of the U.S. subsidiary, then it's going to be, that U.S. subsidiary will also be exposed, or the U.S. parent, whichever way it is structured.
Right, and so there are many international IT services companies in particular who are going to have to think about, moving potentially their senior managers who live in India for that reason. And similarly, many companies do hold at least once in a while a board meeting in India in order to get their foreign directors to come into India and visit the operations and so on. That's also something that may need to be thought through.
Yeah, but
in the context of these new regulations and what should be best practices there. Although, as you said, the rules are not effective yet, but they're coming.
Yeah.
We've run out of time, including for Q&A sessions, so I wanted to thank everybody for participating and attending in today's webinar. As you can see, we could have gone for a lot longer, and there's a couple of areas we didn't get a chance to touch, but we will be sending around our webinar slides as well as the recording. For anybody who has additional questions, they should feel free to contact any one of the panel participants on today's broadcast, and I would like to thank Thomas, Daksha, Joan for their time and input.
Thank you. Thanks, everyone. Thanks, everyone. Thank you.
Thanks, everyone.